All right, what happens if the banks are slow, if your DTI is tapped, or if you want to scale without a lot of personal underwriting that you might find with traditional lenders or hard money lenders or semi-institutional lenders? This is where private money can be your fast lane. So today I'll show you how to structure safe win-win private money lending, whether you're a lender or whether you're a borrower. The documents that protect everyone and a step-by-step case study that you can copy. So first, what actually is private money compared to hard money or compared to institutional lending like banks? So private money essentially is an individual. This could be a person, this could be an entity, or this could also be a solo 401k. This could also be a retirement account. Now they're going to lend on your deal with terms that are set up by that individual or that entity, and this is not based on an institution's playbook whatsoever. So hard money is what I call semi-institutional, okay? So they have some guidelines, they have some overlays and restrictions, and they have a team or an individual at that hard money lender company that is sort of deciding how they're going to lend money, what they're going to lend it for, what the returns are going to be, and what sort of fees you're going to be paying for that hard money. But private money, on the other hand, is sort of bespoke. The underwriting is purely deal-driven and operator-driven. The timelines are much, much faster, in many cases a couple of days, and the structure can be very, very flexible for both parties. The best piece of feedback that I can give to people, anyone, whether they're looking to lend money or whether they're looking to borrow money via private money, is the deal is all about two things. It's all about the deal itself and the borrower and the operator. You have to show your strengths on both, specifically why this deal is safe. So one of the top questions I get from lenders and from borrowers is first position versus second position liens. What does this mean? What am I looking for? But first, my name is Jeremy. I'm a certified mortgage advisor based in Phoenix, Arizona. We lend all across the country, and we deal specifically with investors that are looking to fix and flip, doing DSCR loans and private money lending. We also work with homeowners and home buyers across the country, whether it's conventional, FHA, VA loan products. We specifically empower realtors. We advise homeowners and we consult with investors to help generate wealth through leverage in real estate. So I appreciate you tuning in. I hope you enjoy the rest of the video. So first versus second lien position. So first lien position. Now, everyone should be focused on first lien position when possible. And why is that? Well, first lien position means that if there's a sale or if there's a refinance, that first lien position lender gets paid off first. They have priority. This is also known as senior lien position in a lot of cases. And this is the safest lien position and typically carries the lowest rate and lowest cost through a private money lending resource. Now, second lien position, it is junior instead of senior. This is a junior lien position, and it is not as safe as the first lien position. And what you'll find is if lenders do agree to lend to you in second lien position, generally there's more risk. So they're going to charge higher interest rate, and they're likely going to charge higher points and fees. This is just tighter guardrails for both borrower and lender. So as an example, if there's a property sale and the property is worth $300,000 and the first lien position is $240,000 and the second lien position is $20,000, if the property for some reason sells or refinances at $250,000, $240,000 goes to the first lien position and they're now paid off. But now the second lien position is only getting half of their investment. They're only getting $10,000. So in this case, that borrower is still going to owe that lender $10,000. Now, what are typical private money lending terms that you might find as a borrower? So these are very common ranges, okay? And there's no set in stone guidelines here. So everyone, when you're out shopping as a borrower or you're offering funds as a lender, this is a moving target here, but you're going to find interest rates anywhere in the range of 10 to 12%. And you might find 1 or 2 points, maybe a little bit more than 2 points, depending on the criteria for the deal and the borrower. With second liens, I often see rates in the 14, 15, 16% range. And I also see points and fees 2 to 3 points, maybe a little bit higher, again, depending on the deal and the borrower. And these terms move around, okay? And they move around based on the experience of the investor, the experience of the lender, and specifically the deal criteria. So the better the deal, even if you're less experienced, generally the more favorable the terms for both first and second lien position loans. And quick red flag reminder here. So if you're dealing as a borrower, if you're dealing with lenders And there's lenders out there that will advertise all over social media, hey, we got 100% financing, just click this link and fill out the application and we'll get right back to you. And then there's a fee that you have to pay as a borrower before you see any terms. Run the other direction. That is not a lender you want to work with. No legit lender is going to ask you for an application fee or a deal processing fee or an underwriting fee up front before you know the entire term sheet, before you know all the data points on the deal and the total cost of capital. All right, let's talk about risk box, your risk profile. So all in all, you want to keep it pretty boring. So you want to target 70 to 75% maximum of after repair value for your total all-in number. Okay, so basically if you have a deal that you pick up and you need some rehab on this deal, if the purchase price plus the rehab comes in at 75 or 70% of the after repair value, if you sold it on market, that's a good place to start. So if the time is working against you, or if the market starts to do market things and wobbles a little bit, you've got a little bit of a buffer room, not just for you as the borrower, but also the lender. And they're going to want to see those figures. They're going to want to see a little bit of equity there in case there is a reversal of fortunes somewhere in the deal where it has to be sold, or the lender might have to take over and execute whatever needs to be done to get this deal to the finish line. All right, let's talk about 6 quick things that you need to provide to a lender as a borrower. Think of this as a checklist. Number 1, you want your resume or an operator profile, a borrower profile, a bio, a resume. On an operator resume, you're going to want to talk a little bit about your experience. Photos are amazing. The more photos you have, the better, to show the before condition of the property. And for deals you've done in the past, you'll need before photos and after photos and a little summary of what happened on these deals, both good and bad. It's super critical. If you have 3 or 4 amazing deals that you're putting into your profile, it would also be wise to include information about deals that maybe did not go well. Specifically, they did not go well and what you did in order to get that deal to the finish line. And here, honesty builds trust. You want to be as transparent as possible about not just your wins, but also your losses. Second thing you're going to want is a comparable sale packet, a comp packet. Now here, this is going to be good. So here you're going to want 3 to 6 closed sales that are comparable to the property that you're going to be flipping or turning over. You want those comparable sales in a tight radius, whenever possible, within a half mile. Some areas outside of dense urban metropolitan areas, you want to go out maybe a mile at most. You want recent sales, so the days on market for these properties, you don't want to have them sitting on market for a year. You want to make sure they have like-kind upgrades that are going to be comparable to what you're going to be doing to the property. And also, you're going to want to note outliers. Number 3, you want a detailed scope and rehab budget. And when I say detailed, I mean you don't just want to put $35,000 in rehab on there and $5,000 for contingencies. It's too general, too broad. So it's wise to put in things like plumbing, right? Plumbing, line item, roof, line item, HVAC, line item, drywall repair. Do you need to do any landscaping to the property? Do you have any roof work? And the more detailed and the more quotable the bids are, especially if you get bids from contractors, the better. If you're guesstimating and all of your line items on your budget are round figures, that's okay, but the more detail here, the better. You also want to include a timeline for the rehab. That is a frame for a timeline, so 3 to 4 months for some of these rehabs is typically what I'm seeing lately. And you definitely want to have an idea on how you're going to draw these funds. So if you have a rehab of $35,000, it's likely the private lender is not going to issue you 35 grand at closing, okay? They might issue you $15,000 or maybe $17,000, $20,000 up front, maybe 50% of the entire rehab draw up front to get the project started. But to issue more funds, they're going to want to see completion. They're going to want to see progress photos and pictures along the way so that they can feel comfortable dispersing a large part or all of that draw to you to finish your rehab. So you're going to want to have your deal math. Number 4, this is deal math. You're going to want to know the purchase price, the closing costs. You're going to want to know the rehab fees and the draw fees if there's any draw fees. You're going to want to have dialed in after repair value. This is the value at refinance or on the sale. And then you're going to want to have a little bit of information surrounding your exit plan and what that looks like. So if your plan is to put this property on market, get it under contract and get it sold, Well, if you have a 3 to 4 month timeline for your rehab, it's not reasonable to think you might sell in 3 to 4 months. So you have to add that sales process for time on the end of that rehab budget timeframe. And a really good note here is if you have one exit strategy, and that is to sell the property after it's rehabbed, what happens if the property doesn't sell? You want to answer those questions fully and completely, and you want to have that backup strategy in place. Hey, if we don't sell within a period of 2 or 3 months, we're going to take this property, we're going to refinance it out with Jeremy, hopefully, and then we're going to take those proceeds when we refinance and we're going to pay off our private lenders and hold that property for a year or two. Maybe we'll turn around and sell at that point. Or heck, maybe we'll just refinance it and keep it as a rental forever in our portfolio, and that's also good too. Number 5, you want to have a team roster. So you want to have information as to who's helping with the rehab budget. Is it a general contractor? Is it a handyman? If you're virtually flipping, who is your point of contact there? Do you have a realtor or a property manager or a partner in the area where the flip is located that's going to assist in management of the project for you? Do you have title and escrow contacts? Do you have insurance contacts? Do you have a property management company if you're going to refinance it out and then rent that property out into the rental space? And number 6, calendar. Dates on a calendar are fantastic. We want to know the time frame when we're closing. We want to know when your first draw will be expected, when your second draw will be expected. Things change, timelines change during this process. So it's rare that you'll have your dates lined up and you'll hit those dates exactly once you start the project and get moving. But we want to know what those timelines are as lenders. Now, why this all works, these 6 bullets are fantastic because it proves to the lender that you know what you're doing, that you have a plan, that you have a backup plan, and that you have the right resources and individuals in place to get this property from start to finish. You want to frame these deals as opportunities for the lenders, not as just a benefit to you and your team. Now, if I'm a private lender, some of the things I'll look for, and we'll just do this in the same format. We'll give you 6 bullets for the lender's perspective on what we're going to need here, okay? So number 1, as a private lender, you're going to want to do your deal due diligence. Deal due diligence, that's tough to say. You're going to want to do your deal due diligence. So comparable sales, time frame, all the numbers lined up, your exit strategy or strategies, and then all the math with the deal. Deal analyzers, spreadsheets, they work great for this purpose. I underwrite to my own stress tests. Many lenders do the same. So while your deal may be amazing on paper, if the deal that I'm underwriting and when I do my due diligence, if those numbers don't jive, well, we'll have a quick conversation about it and figure out where the numbers are a little bit different, and we'll try and shore those up to see if this deal can be a good fit for both sides. And number 2, an independent evaluation. Now, this could be as simple as going online and doing some comparable digging as a lender. You can also have a broker price opinion done by a realtor, or you can get an appraisal ordered. You could do a desktop appraisal or an in-person appraisal as a lender to make sure that the numbers jive. Number 3, you want to keep track of the documents to keep you safe as a lender. A lot of cases, this involves a deed of trust and a promissory note in most states that we deal in. Now, if your state is a mortgage state, that could be different than a deed of trust state. So do a quick Google search or a little ChatGPT kung fu and figure out the most common documents that you would require as a lender to protect your interest. You're going to want these items recorded at closing. You're going to want to make sure that the insurance also lists you, the lender, as a loss payee in case there's any substantial loss that occurs. And also, you want to make sure you gather entity documentation, the LLC documents. If the borrower is closing in an entity, you want to review those as well. Number 4, and this is specific to the state that you're operating in, you want to have state-specific protections in the form of documentation. This also includes counsel, right? So whether it's attorney and title, you can have title or an attorney, in this case, review your documents. You can also use a transaction coordinator, and there's a ton of good resources for transaction coordination across the country. Make sure these folks are part of the transaction. They're going to make sure the paperwork's dialed in, the right protections are there, not just for you, the lender, but also for the borrower. And you also want to confirm what happens if there's a default. What happens if there's a foreclosure? You want to make sure that's all laid out as well for both sides. Number 5, reserves. This is big, especially where there's a lack of experience for the borrower or investor. If there is something adverse that happens throughout the transaction, does the borrower have the funds sitting on standby to make these interest-only payments or to make whatever payment arrangements are laid out if the deal takes longer? If it takes 2 or 3 or 4 months longer, Oftentimes deals are still deals even though there's delays, and sometimes there's delays in this business. And then number 6, you want to get updates. You want to have a predetermined time frame where updates are coming in. A lot of times this is weekly, or it could be at certain stages of the rehab progress. Maybe that's once every 10 days or 14 days. But either way, you want to have a clear communication schedule for updates. And as a lender, you want to hold the borrower and the operator accountable to these updates to make sure that your funding is secure and the deal is rolling along forward just like everyone thought it would when we closed the deal. Monthly draws or every couple weeks, draw inspections. You want to make sure those are all part of this process. Now, one question I get also from borrowers and investors is, hey, what is the difference really, and what is more favorable between an equity position or a debt position? Okay, so here's how I classify these two. So if you're looking at an equity position, this is where the lender might actually take ownership in this property to protect their interest a little bit. There's pros and cons here. The pros are you'll have a much better position from which to make decisions if there's a default or there's any issues that arise or there's some delays. A lot of times a lender can step in and start assisting or start managing that property to make sure deals get to the finish line. Equity position could be anything from vesting in your own LLC as a lender. That gives you 100% certainty that you own the property and that the individual that is borrowing these funds from you and working with you is doing things that they need to do because, well, the property is not in their name. So they're going to need to in order to get the percentage of profits that you agreed to at closing. So equity is very strong, but the downside for equity is if there are any things that go wrong, you're going to be the one, or your team, you're going to be the one that steps in to get this deal to the finish line. Now, lending position or a debt position, on the other hand, is very strong. It is definitely a lot more passive. There's a predictable return here, and there's usually a good amount of interest that you can generate, again, 10 to 12%, but you are a little bit capped on the upside. So if you're charging interest and then you're charging points, well, you're going to make that interest for a 3 or 6 month, 9 month, or 12 month period. You're going to be, for the most part, hands off so long as the project is going along as everyone expects it will. And the downside is you have a little less control if things go wrong, but you do still have control if you're setting your protections and your documentation up the right way. What a lot of lenders do as part of their portfolio profile is they will blend a combination of debt and equity. So they'll have debt positions on some, they'll have equity position on others, and it helps kind of balance out the risk profile for your portfolio if you're lending and you're doing this a lot with a lot of different borrowers, or a lot with the same borrower, which a lot of lenders do. Now, a lot of questions I get about lending involve, hey, Jeremy, I have a little bit in business checking, we have a little bit of funding, or a little bit of capital to use, but we like to use, funds from our solo 401k or from a self-directed IRA. This is fantastic. This is a great way to tap into these resources that are already sitting and gaining a passive return. You can pull funds out from these accounts that are compliant accounts, use those funds to lend out to private money lender or to investors. And then those investors, as they pay this return back, all those funds and the returns can go back in to some of these types of retirement accounts. And this is really amazing strategy. A lot of our private money lenders use their retirement accounts for this purpose. Very, very strong. All right, so real quick, I'll run through a case study on a private money deal that we just closed not long ago in Detroit. So we were able to access private lending through a individual that is lending directly from their retirement account. They were able to come into this project. They were bringing 100% of the purchase price and 100% of the rehab budget. Okay. Now the points on this deal was a little bit more than 3%. This is a newer lender, so they like to mitigate their risk a little bit by charging just a little bit more. But rest assured, if we run back through another deal, second, third, fourth deal with the same lender, we'll probably get a little bit more favorable terms than we did the first time around. But they came in with 100% of the purchase price. So within 2 or 3 days of getting an approval, both from title, insurance, and the private money lender, the private lender wired funds directly to title. We listed their retirement account as the loss payee for the insurance, and they're also in first position on the lien when the property closed. All right, so they have ultimate protection here, both from an insurance standpoint and from a vesting standpoint with a promissory note and a deed of trust. So the purchase price was $92,000, and then there is a $50,000 budget for rehab. So all in, all together, including the closing costs, we were pretty close to $150,000 invested in this deal. Now this deal is going to take about 3 months to rehab. Okay, that was the initial game plan, and we're still on track to hit that 3-month target. Once that property is completed, we're going to perform a DSCR, cash out refinance, where we're going to take out all $150,000, both the purchase price for the lender and the rehab budget that the lender lent to us. And we're going to cover both of those things with the cash out refi. So we're going to get all those funds back. We're going to pay off the private lender. The private lender is going to be paid off. The lien's going to be released at closing on the refinance. Now the lender, the institution now that's doing the refi, is going to supplant the private lender in first lien position. So the first lien position will now be the DSCR lender. Loss payee is adjusted on the insurance. So now that first position lien with the institution lender is covered. And the private lender now gets paid off, plus their return. So in this case, this property has an ARV of about $275,000, give or take a few thousand on the end there. So 75% of that figure is enough to cover the first lien, the rehab, and the closing costs that we're going to absorb on the refinance. So we pay out the private lender completely, we move on to the next project, we'll bring the same deal scenario, we'll bring the same metrics, the rehab budget, the comparable sales, the timeline, the team we're using, the contractor, the property manager, and anyone else, realtor, anyone else involved in that transaction, and hopefully he'll give us another deal down the road and become our private lender for deal number 2, and so forth. Why this deal was really strong is all of our numbers came in well below 70% of ARV on the initial purchase, which was fantastic. The rehab is a tight timeline, and it is time boxed. We provide weekly updates with one of the technologies we use that our team uses to provide photos, real-time photos. Every time there's a photo update, we have a minimum of 25 to 30 photos on every update. It is in an online portal, so it's easily shareable with the lender. So at any time, if they have any questions about the progress, they can just log in and see right where we're at. And plan A is obviously the refinance. The plan B is still a refinance. Now, plan B just might not refinance all of what we owe. And in that case, we might need to come to closing on the refinance with a little bit of money in case our ARV is way off. Granted, we don't think it is at this point. We think we're in a really strong position, and the rental rates on this property are really, really strong and far away exceed what the debt service coverage ratio numbers need to be for an approval. And this is key. So what I like to do here is I'm going to prepare a borrower profile and a lender profile that includes some of these bullets I went over today. So you can take this document, you can dump this into your research when you're scrubbing through new deals and trying to figure out a flip that will work for you or a rehab project that'll work for you in your market. So you can DM me for details, you can drop a comment below, and I will make sure to send out these borrower profile and lender profile documents to you so you have them on hand. Think of it like your cheat sheet. When you put this all together, you're going to lead with the safety of the deal for not just you as the buyer or borrower, but also the lender. You want to put yourself in the lender's shoes throughout this entire process. The deal can look amazing to you. You just can't be too aggressive on your numbers and your terms. It also has to make sense for the lender. So if you continue to put yourself in the lender's shoes and ask yourself, would I lend to myself on this deal? It's probably the best question you'll ask through this process. You're going to find holes in your underwriting this way, and you're going to get better at underwriting. You're going to get better at coming up with comparable sales, rehab budgets. You're going to learn to lean on the right resources and individuals to help you with these projects, ultimately making you a better borrower. And in a lot of cases, making you more informed as a lender if that's ever a path that you choose down the road. And I highly recommend looking into lending as well. So if you want the borrower packet template, please drop a comment below and say borrower, and I'll get you a copy. And if you want the private lending template that we use, and even a copy of our borrower profile, which is sort of like your resume, I'm happy to provide that as well. And then if you want a checklist as a lender, please drop lender below in the comments, and I'll make sure you get a copy. All in all, this is a great time in real estate as both a buyer and investor, as well as a lender. There are a lot of opportunities out there in a lot of different markets. There's still a ton of investment activity going on, regardless of what the economy is doing and what the rates are doing. And all you have to do is get out there, do a little research, do a little due diligence, possibly link up with people that have done this before just to get your feet wet and make sure that you're accounting for all the gaps in education and information that you might encounter along the way. And you're going to be in a good spot. So definitely appreciate you tuning in. If you have any questions about private money lending where investments are concerned, fix and flips and rentals, or if you have any feedback on deals you've either lent on or deals that you've borrowed funds for, whether good or bad, please drop them below. I would like to interact with you and have a conversation there. And if you want more information down the road for how to create wealth through leverage in real estate, using mortgages and using financing, both private and institutional, please subscribe. I promise to bring out the best content that I can to help educate you and help provide resources for you to create a little bit of momentum in this space. There's room and opportunity for everyone, and I want to see you win. And if this video was helpful, please drop a like and please drop a comment. It would be great to interact with you, and I respond to every comment personally. Thanks so much for tuning in. Really appreciate you being here and watching these videos. I'll see you in the next one.